The market just handed you a masterclass in how two indexes can live in completely different universes, and most investors are only watching one of them. We need to talk about the Russell 2000 versus the S&P 500, because the gap between these two benchmarks right now is telling a story that you absolutely cannot afford to ignore. Most people treat the market like it's one thing, one mood, one direction. But that's like saying the weather when one city is flooding and another's on fire. The S&P 500 and the Russell 2000 are tracking fundamentally different animals, and confusing them is the kind of mistake that quietly bleeds portfolios dry. Here's the engine under the hood. The S&P 500 is dominated by mega-cap technology, communication services, and healthcare giants that generate revenue globally, while the Russell 2000 is packed with small domestic companies in financials, industrials, and consumer discretionary sectors. Think of the S&P as a multinational luxury cruise ship, and the Russell as a fleet of local fishing boats. Both are on the water, but a storm hits them very differently. For years, the narrative was that small caps were the scrappy underdogs ready to explode higher as the domestic economy roared back, and that story had real momentum behind it coming out of the pandemic lows. Then, interest rates started climbing, credit tightened, and those small fishing boats suddenly couldn't afford the fuel, while the cruise ship had already prepaid its expenses with cheap long-term debt. The psychological whiplash here is real analysts were practically writing love letters to the Russell 2000 in late 2023, calling it the most undervalued pocket of the entire US equity market. Fast forward, and the sentiment has done a complete 180, with institutional money rotating out faster than a spinning door at a hedge fund happy hour. Small caps are far more sensitive to borrowing costs because roughly 40 to 50% of Russell 2000 companies carry floating rate debt, meaning every Fed rate hike hits them like a direct punch rather than a distant echo. The S&P 500's largest constituents, by contrast, locked in historically low fixed rate debt during 2020 and 2021, essentially building a financial bunker while rates were still friendly. History does rhyme here, though we saw the same divergence play out during the rate hike cycle of 2004 through 2006, and again during the post-financial crisis recovery, where small caps initially surged, then struggled as capital costs rose. The lesson every cycle tries to teach us, and we keep forgetting, is that sector composition is destiny when monetary policy shifts. There's a common misconception that small caps always outperform large caps over long time horizons as some kind of ironclad rule. But that premium is conditional, not guaranteed, and it requires you to survive the brutal drawdown periods to collect it. The small cap premium academics love to cite was largely earned through excruciating volatility that most real human investors cannot emotionally or financially withstand. What's genuinely interesting and a little absurd is that the Russell 2000 has over 2,000 holdings, yet can still be dragged around by a handful of speculative biotech and regional bank stocks, which is the index equivalent of a crowded bus being steered by the most chaotic passengers. Meanwhile, the S&P 500's top 10 holdings represent roughly 35% of the entire index, which means you're getting diversification with a massive asterisk attached to it. So what do you actually do with this information? You treat sector exposure as your starting point for any index comparison, not an afterthought, and you stress test your thesis against interest rate scenarios before committing capital. Sizing matters enormously. Here, a small, disciplined allocation to small cap exposure can add meaningful diversification without turning your portfolio into a roller coaster you'll abandon at the worst possible moment. The practical lesson from every historical cycle is not to time the rotation perfectly, but to be positioned before consensus recognizes the shift, and to have the process in place so emotion doesn't drive your exit. Unemotional, systematic rebalancing has beaten heroic conviction calls so consistently that it's almost boring in investing is genuinely underrated. There's something almost poetic about how the index you choose to ignore tells you more about your blind spots than the one you follow obsessively. Discipline, proper position sizing, and consistency across market regimes will outperform any hot thesis about which index is due for a comeback, whether the Russell 2000 rips higher on a dovish Fed pivot or continues to lag while mega cap tech dominates. A rational, prepared investor has modeled both scenarios and sized accordingly. Comfort with uncertainty isn't weakness. It's the actual edge. You don't need to be right about the outcome. You need to be ready for multiple outcomes. The irony is that the investors who spend the most energy debating Russell versus S&P are often the ones least prepared to act when the answer becomes obvious. Process, patience, and position size, say it with us. Those three things will carry you further than any prediction ever will. And if you're looking to put capital to work beyond the public markets, whether that's real estate investing, home contracting projects, or finding the right lenders, check out our links in the description below, and let's get you started.